I want to talk today about the single biggest obstacle to the next leg of the bull market, fear. It showed up this morning when stocks plunged in response to the SEC charges against Goldman Sachs. Take a look at how fast and furious Goldman shares dropped on the news. Now, the fraud case, it is infuriating, but is it really worthy of a market-wide plunge? It shows you just how much fear is out there. We're down triple digits in the Dow. Now, here's a more revealing measure of fear, guys. $9 trillion. That's how much money sits in Frady Cat accounts like checking and money markets. That money missed out on a, 60, 70% rise in stocks the past year? And just one last thought on fear. Remember what a stuntman for a James Bond film said after he did this. He skis off a mountainside. He goes into free fall. And at the last moment, he opens his chute. And this stuntman said, it isn't the absence of fear that makes courage. Courage is what it takes to overcome your fears, which we could use a little bit of right now. Let's bring in trading coach Doug Hirschhorn, Dr. Doug, and financial planner Jonathan Satowski. Welcome to Power Lunch. Doug, you had a great phrase in your notes this morning about what kind of fear exactly investors are feeling.
Yeah, fear of re-injury.
So re-injury.
Re-injury. I saw this in my sports psychology background working with athletes. They get injured on the field, and then even though they've gone through rehab, they are so afraid to engage in the sport at the level they were months later because they're afraid of going back and getting hurt again.
And so
that's what we're seeing right now.
Maybe that's just wisdom. I mean, come on.
But
you get crushed in the market, maybe you're just more cautious the second time around. Maybe you don't jump off the cliff like an idiot the second time around.
Then we're talking about taking risk, and inherently in the market is risk. But now we're talking about taking what's called smart risk. And I think what we're finding out now is that people were not taking smart risk. They're investing in products they didn't understand. There was poor regulation around it. It's all blowing up now, and that's going to
Well, then that's wisdom. If you don't want to do that the second time around, you want more information, you want to know what's going on, you're not going to invest in things that you don't understand.
Once you have it, then you go back in.
Okay, maybe so. But, Jonathan, what are you going to tell your clients if they ask you, why should I play in this market, if it's a game that's basically rigged in some way, shape, or form?
I think it's pretty straightforward. I think that people have to understand 5 basic principles. Number one, it's never an all-in, all-out idea where that you have to be 100% invested or 0% invested. I think people going to extremes shoot themselves in the foot. Although you hear glamorous stories about someone getting it right, if you're willing to shoot for private jets or being completely bankrupt, that may be an appropriate approach, but not generally for the vast majority of the population. The second thing is just an education process, understanding volatility. If you think about what happens in the S&P generally, a 3 standard deviation event is going to give you a minus 50% return or positive 70% return.
Well, if I could just break off your 5 points, because it's cable, we got to go faster. How much fear do you think is still out there? A lot or a little?
Well, as you pointed out, with the amount of people that are like deer in the headlights, people with $9 trillion in money market accounts, people are paralyzed. They expect that the occurrence of 2008 is going to happen every single year. And the truth of the matter is that is an extreme event. And if you assume that down 50, up 70 happened in the last 2 years, you're going to get volatility, and that is what you would expect if you own the S&P
but
it's not going to be to that extreme.
What's the headline effect to your clients and the individual investor when they pick up the newspaper tomorrow morning or they tune into the talk shows and the Goldman story unfolds?
Well,
what's their reaction to that?
Of course they're going to be nervous, and they're going to be worried, oh my God, we're going through this again, and the whole system's going to collapse. But the truth of the matter is, anybody that's investing is thinking about this in a very long time frame. You're not investing for the next week. Most people are investing for goals 15 to 20 years out, so you have to be thinking about it in a long time frame. And the second thing is that if you understand the volatility level, there's a big behavioral science component. If you understand the volatility that you're willing to live with and you create a well-diversified portfolio, then go live your life. Don't worry about it. But you have to understand and make an appropriate assessment of your own buoyancy level. And I don't think people are honest about that because people all want to take risks till they lose money.
Doug, one thing that Jonathan just
those are excellent points, by the way. Excellent points.
Well, he just said that investors invest for the long term. I think one of our problems is that most investors, many investors, invest for the extremely short term. What do we have to be afraid?
You've got to think long term. And what he's saying here, which is so true, is we generalize. Human beings are flawed. We see one little thing, we think, oh my gosh, it's the end, it's the worst. Make no mistakes. This is the moment in time when my clients will behave. Their years will be made right now because everyone, the masses, are getting panicked, and they're saying, wait a second, fundamentally, nothing's really changed in the world. The economy is global. These are buying opportunities for a lot of those people.
That's true, but you look at something like what happened today, and that's going to have a big psychological effect. I mean, this is exactly what the general retail investor is exactly afraid of, is that the game is rigged, that
and
somebody
yet,
as
no
powerful
general
and
retailer
well-known
ever bought a CDO. I never bought a CDO.
Yes, but
you
the
didn't.
bottom line is that Goldman Sachs is accused of lying. They're accused of misleading their clients and telling them, you know, Paulson's not in on this, he's long, he's not. I mean, this is like a basic breakdown of fundamental trust. This is exactly what the little guy is afraid
But you're talking
is
about
going
the general
on.
retail. What I'm talking about is the elite mindset.
The real guy.
I'm talking about the elite. Anybody can have the elite mindset. And I'm saying for the general person out there, you can have the elite mindset. It's not an exclusive club. That says, look at the bigger picture on this. Yes, the world stinks, and yes, Goldman's might have these issues, and yes, there's got to be revamping. But it doesn't mean the world is falling apart again like it did.
No.
Bingo. And that's the return of fear.
I don't know that they think that the world is falling apart again. I think they just think that they do not have a fighting chance on Wall Street because it is an inside guy's game, just like the flash trades, just like the dark pools.
I get
it's an inside game.
And yet then why is my portfolio up 60% with a market rebound? I mean, if it's an inside game, how do we all manage to come back, right? Because we stayed in.
You're probably in mutual funds or something like that, where you give it to Fidelity or you give it to, you know, Vanguard or something like that. But if you're an individual investor who wants to buy and sell stocks, or buy insurance against your portfolio. Do you really have a chance in that game?
Right. Jonathan, wait. Jonathan, are you going to tell your clients that they're unduly worried about the Goldman headline, or indeed if they want to get out, they should?
No, I think the thing that's interesting, I just did this study yesterday. If you look at the daily movement of the Dow Jones Industrial Average all the way back to like 1926, the market daily is only up about 52, 53% of the time. So being an investor is very hard. That means that 48% of the time you're going to go backwards on a daily basis if you were measuring it as a day trader. That's
that's
tough.
Encouraging.
That's ugly.
So if you're thinking, well, I mean, if you're thinking very short term, you're going to say everything's great, everything's terrible, everything's great, everything's terrible. And it's, you know, it really requires a tremendous amount of patience and resiliency and having a long-term vision. And you know what? Fortunately, we still have Warren Buffett alive to remind us that you have to be thinking for a lifetime.
Yeah. All right. Thanks very much. And thank you, Dr. Doug.
Thank you.
Good job.